Alan, Darby, Jacqueline, Martinez. This is the Buyer's Boardroom. Learn the most about who you are today and where you want to be after.
Hey, welcome back to the Buyer's Boardroom. How's it going, Alan?
It's going awesome, Jacqueline. Just sitting here in 30-degree temperature in North Carolina. Snow's on the ground, so it's like getting ready for Christmas. So
Nice.
very excited.
Well, 1 point for California because I think it should be gorgeous today. Might hit the pool, but
You make me jealous.
it feels good to be back in the studio. I got to admit, I'm feeling a little like hyped up right now.
Are you?
I was randomly reading the comments on the podcast, like on the Apple side of it,
Yeah.
and like I was thinking back to like when we were originally launching the podcast and like what do we want the vibe to be, and we want to talk about M&A topics but in an approachable way and direct and funny, and like listeners are really feeling that.
Really?
So
That's awesome.
glad to see.
Maybe we can take it up a notch today.
Yeah, let's do it. Yeah. Awesome. Okay, well today we're going to dive into internal versus external succession planning options.
Yeah.
I think it'll be really fun to walk through the assumptions of why people tend to think that one is better than the other, and kind of where that might be rooted in inaccuracies, or what else to be thinking about if you're leaning one way or the other, what the trade-offs might be. But super important topic.
Everyone, I mean, not everyone, but it's a very common theme that we deal with advisors who are really kind of trying to decide what's the preferred route in internal succession versus transacting with an external, call it a third party. And they definitely bring to the table, I'll say biases, and that doesn't mean to be like that's wrong. But they're rooted in certain assumptions that we want to unpack and make sure that the internal succession might be the preferred route for you, but we want to make sure that it's rooted in reality and not based on some flawed assumptions. So should be a great time. I'm super excited also to be interviewing David Wahlen at CapTrust. That's
absolutely
perfect firm for this, to give us their opinion on this very timely and topical matter.
Absolutely. Yeah, they're so focused on the way that they make sure that the equity is spread across the team that's joining. Really making sure that all team members are aligned to be at CapTrust for the foreseeable future. And he also loves to weave in Seinfeld quotes, so I hope we hear a little bit of that too.
We'll get it out of him. I love Seinfeld.
Right.
Okay, so let's start. What would you say are some of the assumptions? And let's start with the frame that I think is probably universal, particularly with firms that have Gen 2 advisors. And that frame is the easier preferred route would be an internal succession. I mean, wouldn't you say that that's their kind of their starting point, is they assume that the Gen 2 advisors on the team, if they handed or facilitated the equity transfer, let's say from the senior owners to those junior people, that would produce like a better result?
I think so. And also, but the reason sometimes being is that they're great advisors. They take exceptional care of the clients, and they're really great at that aspect of it. So then there's the assumption that they would want to run the business and make more decisions and do more than that, which may or may not be true.
Well, I like to phrase it this way: it's the risk that they know. Right. It's like they're familiar with these people. These people know the clients. They've been interacting with them for a period of time. And so that familiarity just makes it presumably the more comfortable choice. And so that's really what I wanted to focus on. Is that true, that it is the better outcome? And so there's a few things that I think what we want, and again, we're not saying the internal succession is not the best route. What we want to make sure is just rooted in actual reality. And so the things that we want to really raise awareness to will be the first thing is mistaking a capable advisor for a capable business owner or entrepreneur. I mean, the reality is the owners that have built the business they're entrepreneurs. They know what it's like to meet a payroll when there's no money coming in. They know what it's like to take risks, to invest in their business, for long-term benefits, and that's a certain DNA that is an
Right.
entrepreneur, right? Not everyone, and I'm not saying entrepreneurs are the best, but a lot of times employees don't have that same DNA. And so
Yeah. The comfort around uncertainty.
absolutely. Yeah. I mean, everyone who's
Yeah.
an entrepreneur that's listening to this knows exactly what we're talking about. And so you
Hmm.
really have to ask yourself a question, because this is not about, entirely anyway, it's not about transferring ownership to a person who is capable of serving a client and doing it
Right.
under the same standards that you have, right? That is a part of it for sure, but it's also, there's a business decision in here embedded in this transaction, where are these people capable of running a business, managing people, managing process? That's a different thing than being a great advisor. And so, not saying that your Gen 2 advisors aren't capable of doing that, but you really have to be honest about are these people entrepreneurs? Because if you're going to transfer the equity to them internally, that's the risk that you're taking, is that
Right.
they're going to be able to take this entity that you've grown, you and your partners probably, and continue that growth. Certainly, you want them, financially speaking, you want them to be able to pay you, the value.
Right.
Probably going to be seller financed debt here, and they can grow the business and not end up having it put back in your lap in 3 to 5 years if it doesn't work so well.
That's right. It's the ongoing responsibilities of running the business that they may or may not be up for, but then separate, but the first step being actually buying in, getting the financing in all different ways that can be structured, but at the end of the day, they're taking some risk and betting on themselves that they can sustain the revenue, the EBITDA,
That's right.
to be able to make those payments to you, and you as the founder, like you're saying, may also have to put up the guarantee or secure it by the business, or
100%. Well, and also,
yeah,
so you're raising a good point about their ability to go obtain financing or whatever mechanism they're going to have to write the check, let's say, to the exiting or owners who are selling their equity. It's the valuation difference. And so this is
yeah,
something we've really seen come to bear over the last 5 to 7 years, as valuations have just increased to a point where it's frankly difficult for that younger team to be able to write the check that the external valuation would command. And so we
hmm
see that being a pretty big impediment, even with internal successions that have been sort of informally or formally designed, is that the valuation has changed so materially that the younger advisors are saying we don't want to write that big of a check, or we can't write that big of a
yeah,
check. So we had a firm recently engage us, and that was the reason, is that the younger advisors who were wanting to buy the firm just couldn't compete with what that firm would command in the open market. They want to be a part of it, but they realize that, hey, this is not going to be something we have an appetite to do. And that kind of ties back to their willingness to take risk as an entrepreneur, to my
right.
first point. So that what would you say the valuation difference is between?
I would say at least 25 to 30% lower doing
Yeah,
an internal transaction versus an external one. So, I
yeah,
mean,
I would
that's
agree.
material. Yeah.
It's a big deal. And so, like, what we've seen is, like, firms that have had these succession agreements, let's say, with the younger team, and they have a legacy valuation metric in there that is based on what practices were valued at 5 to 7 years ago. And
Hmm.
today that's just changed so materially. And so it's really, from a financial only lens, it's really um, prudent for the owners to see what their firm was worth on the external market. We're of course,
Hmm.
that's what we do at Alaris, so we're biased perhaps to say that, but it is the reality,
Fair.
is that the
Yeah.
valuations are substantially higher than what the internal transaction. Um, I also want to raise one more assumption here, often that causes owners to let's say, favor an internal succession. And that is the perception that if they transact with an external party, a third party, are they taking away opportunity from their Gen 2 advisors? What do you
Right.
see? Is that actually what's happening here if they sell to a third party?
No, not at all. I mean, there are some buyers that aren't willing to go through the complexity of figuring out how to get next gen equity, and so I wouldn't, I wouldn't lean towards those when we're thinking about who would be a great match. But the most buyers are waking up to the fact that it's really imperative for the long term success of the business and retaining the business in the long haul to have the next gen advisors as shareholders, both as part of the initial transaction when they're joining, but then also giving them opportunities over time as they're exceptional contributors to the business and so on, that they can continue to earn more equity over time, in similar ways that probably if they were staying internal, that would happen over time in their current world. So
Right.
kind of mirroring what the founder would have liked to have done.
Well, I think overall, everyone needs to get this firmly rooted. Like the buyer is not interested in removing opportunity, and let's say it's equity opportunity, which we're speaking about typically,
Yeah.
from people who are driving the growth of the firm. So I would say this sort of categorically, obviously subject to the buyer nuance, but like there's an expansion of opportunity, not a contraction of opportunity when you seek a third party transaction.
Mm-hmm.
To your point, like if you had made promises informally or formally to the junior team on ownership, you can facilitate that at the initial transaction. So like if there's
Right.
equity that you want to get in their hands prior to the transaction, or if it's just value economically, you can always do that. Just there's no change of direction when you transact with a third party there. You can get that value in the hands of the team. But going forward after the transaction, all the buyers want to have equity in the hands of the people that are driving the bus. And so how they do that is different. I'm super excited to talk to David about that and how CapTrust views that. But I would say don't view a third party transaction in any way removing opportunity. That may be a difference, like of how they operate, the client experience, the advisor experience could be different in a new world. But from an
Yeah.
opportunity perspective, I don't think that's going down. In fact, I think it's probably going up.
Right. Yeah. Still having opportunities to earn equity, but then also now their resources to be able to expand their services to clients and things that the advisors now have access to, is such an improvement as well. So just net positive.
Yeah. So
Yeah.
when you look at all of the assumptions that kind of point you to the internal succession, are your Gen 2 advisors capable entrepreneurs? That's got to be, that box has to be checked, yes, I think, or else you're taking too much risk in handing them the keys to the car if they're not comfortable in that ownership role. Are you willing to accept a lower market value? Or, I mean, in theory, you could get them to value the firm the same. I think it's going to be quite difficult for them to do it. But on average, we
Sure.
would expect it's going to be about 25 to 30% lower, an internal valuation math that we've seen. And then are you assuming that if you transacted with a third party, you're removing opportunity from the team? And I think that answer is absolutely no, you won't be.
Mhm.
And so it's
Yeah.
very, again, nuanced based on the buyer that you're talking about. But if those are the assumptions, we want to make sure that all of those items are being evaluated, not just the perceived ease of transition from a client perspective and a team perspective through the internal. That doesn't mean it won't work, but it's like the external transaction, I think, if you remove those improper filters, could be perceived in a much better light. So,
Mhm.
how do you determine, given that, like, how would you know if you have the team members that are capable of stepping into that leadership role? Any thoughts around that?
I think for that it would be outlining to them how it could work to facilitate those transactions, talk about like the core parts around how the typical structures work, the financing that they might need, and kind of like outline to them, here's the plan, how it would look. We would work with the lawyers to do an operating agreement so we can decide on how decision making works while me as the founder is still getting paid out, and like walk through all of that and see the reaction. I mean, I think that would
Well,
be
so
my,
that's a structural like discussion,
yeah,
just to say this is the reality of the economics. And are you one comfortable with that sort of plan? And then secondly is, are you capable of
right.
executing on that plan from an economic perspective? And the reality is that most of the younger Gen 2 advisors probably don't have the financial balance sheet, let's say, to be able to do this individually. They often need the owner to sort of be the
Guarantee
guarantor or
it.
the buyer. So you're
Yeah.
sort of self-financing out of your own cash flow this internal transaction. So they have to be capable. But I was more interested in like how do you quantify, as someone who's worked with you as an employee for years, if they have the business owner entrepreneur chops? Like
Hmm.
I presume you could probably invite them into your executive decisions, that if you have partners, for example, get them involved in the high level strategic decision making, see how they function there. Are they put them in scenarios where they have to manage people,
Hmm.
see how they do interact with the team. Do they command their respect? Put them in decision making positions where they have to make difficult decisions regarding
Right.
the business or the team. You know,
Develop a marketing plan and like, oversee that
yeah,
part of it. And,
grow the business.
like basically thinking all the things that the founder advisor is doing today in some way, either they're overseeing who's doing it, but calling the shots on what's going to happen. What parts of that could the existing members of the team take on today? Or if there are gaps, what would be the plan to get their knowledge up to a level where they could execute on it? And
Yeah,
do they have the appetite to learn and grow
do
and
all
do
that.
that?
Yeah, I think
Yeah.
their articulated desire to pursue these things, whether it's verbally or just through their actions, is critical to watch. Like if they're not, like, the entrepreneur to me is just a classic self-starter. You don't need to tell them to get up and go to work. You don't need to tell
Right.
them the things that they do naturally. And so you could probably give your team a few of these types of tasks and just see how they respond. And you get a pretty quick indication of whether or not they're going to be able to take the reins from you as the owner, not only from the client perspective, but just for the team, the financials, all the rest. And I think that's where the third party transaction, particularly the buyers who have phenomenal Gen 2 initiatives. I mean, there are
Right.
buyers out there that have invested millions of dollars into full blown, call them Gen 2 universities, where they have full
Hmm.
staff that their job is to bring in younger advisors, put them through a very structured curriculum on how to be a great financial advisor, but then also how to run and operate a business, how to manage people, and so forth. So they have this, I think, are like nice guardrails for them,
Right.
that the owners who are transacting don't necessarily have to implement. Their partner has the resources internally, that infrastructure, to just take that next gen advisor and really mature them, progress them in their career, not just initially, but just ongoing as well. And so
Hmm.
that's something that, as you step back and you evaluate the people on your team in this regard, when you see the resources that some of these buyers bring to the table along those Gen 2 mentorship training programs, it's really phenomenal. They're all
Absolutely.
preparing for the inevitable. Like all the firms that have done these serial acquisitions for years, they've got this succession bubble, let's say, brewing in their own organization, and so they, recognizing that, have decided that we've got to be able to really grow our own next gen advisor, train them, equip them, so that they can, so that we don't have this issue when our partners are at the point where they want to exit and retire.
That makes sense. I was just thinking too, a nice middle ground for maybe someone who's on the, like, as a next gen advisor who's on the fence of, would I want to take that leap and do an internal transaction or not? Oftentimes in the larger, like national RIAs, there are regional opportunities to still lead and have a bigger role than just the local office as well. And so that could be a nice way to contribute to a broader organization, still make some strategic decisions and be involved in the direction of the overall firm, and working outside of the local office too, if that's like of interest.
Yeah, well, that's that career pathing. It's
Mhm.
the in any smaller firm, the existing owners are the ceiling of opportunity for
Right.
the team. It's just the reality, and that's nothing wrong with that. I mean, that's great. If you're a growing, healthy organization, the team is comfortable in that environment. But when you transact and you're part of a broader organization, for those individuals on your team that may want to do something beyond the local office, those opportunities exist, and buyers are frankly starving for those types of talented people that can come in and just whatever role that might be, a corporate role, could, like you mentioned, like a regional role, a
Mhm.
broader role beyond the local office, let's say. They're really hungry for those people who raise their hand and say, that's something we want to do. And so
Mhm.
that opportunity, I think, is far and away greater in the external transaction than it is the internal.
That's a good point.
Yeah,
Yeah.
yeah. Awesome.
All right.
So, well, let's get to David. Like, I'm super pumped about him and what CapTrust is doing. I know we wanted to have him on because of the laser focus that CapTrust has on equitizing that next gen, and so to get his
Absolutely.
thoughts on why that's important to a firm like CapTrust, and maybe some specifics on how they actually go about it. So, let's bring on David. I'm super excited to have David Wahlen, Head of Corporate Development for CapTrust. David, welcome to the Buyer's Boardroom.
Hey, Alan, thanks for having me. I'm glad to be a part of this. I'm a dedicated listener and just excited to be on the show and talk about what we're going to cover.
Yeah, well, I appreciate the partnership with CapTrust. You guys are a phenomenal firm, and certainly look forward to many, many partnerships with you and the team. So today, the topic is the internal versus external succession. Jacqueline and I have been having this conversation about sort of the embedded biases or thought about the internal succession being sort of the preferred pathway. And in there is some assumptions that are being made that we don't think is correct. So we've talked about that already as well. But I know CapTrust, you guys have I think one of the strongest post-acquisition equity stories in the marketplace. You guys, it's a partnership mentality there at CapTrust. You guys want to have equity in the hands of the people that are driving the growth of the firm. So I want to have some really specific questions about how you guys think about this and how you guys think about incentivizing, let's say Gen 2 on the team. But before I do, let's have the listeners who are not familiar with CapTrust maybe give us a quick introduction to the firm. Anything that you want to share about the scale, breadth of resources that you deliver for your partner advisors and clients?
Sure. Thanks, Alan. Yeah, I mean, so, CapTrust, we like to think of ourselves as just a larger version of most of the firms, that we're having acquisition discussions with. Our leadership, our co-founder, Fielding Miller, broke away from a regional broker dealer back in the late 90s with about 400 million in assets under advisory, which is interesting because at the time there was a lot of banks and insurance companies, being the advisor to retirement plans, and
Right.
There was not a fiduciary mindset yet in the mid 90s around the 401k business. So the roots are in the 401k business in Eastern North Carolina. They had a number of wealth clients as well, but from 97 to about early 2000s, it was really just one new advisor at a time, one new client at a time.
Right.
Whether that client was a retirement plan or a high net worth individual, a little indifference towards that. And so all organic growth focused with the sales mentality coming out of the brokerage world, but just like a lot of founders that we both talked to, just thought there had to be a better way to be independent, fiduciary, fee only, and not have anything to sell back other than air or advice.
Right, advice.
Clients. So really put our M&A hats on, starting in 2006, lifting out retirement plan advisory teams from the wirehouses and out of other RIAs and business management firms that wasn't their core business. And then got really serious about the wealth management space from an M&A standpoint, probably about 2012, 2013.
Okay.
And have just been really lucky and fortunate to have a great business model with some great advisors that, over time attracted more folks like themselves all around the country. And then we just caught the same wave that many of your other guests have with private equity entering the space, kind of the M&A, call it boom of the last 6 to 7 years, and just feel really well positioned going forward. So that if there is, a meta group of firms at the top, we just want to be part of that.
Sure.
I think we deserve to be there, and we have a unique story to tell.
So give me some data points. So people, I know the size and depth of CapTrust, and so maybe speak to the number of team members, perhaps the assets that you manage, anything that you would share that helps people kind of get a sense of the scope of CapTrust.
Yeah, it's interesting that the team members is about 1,650 or so folks around the country, about 80 to 90 locations, depending how you count folks working from a home office or not. Assets, we just crossed $1 trillion a couple months ago under advisement, which is with a T, big number. Not 92% of that, about 920 billion. Retirement plans, endowments, foundations, pensions, things like that, other asset pools. We're coming up towards the end of the year. It's been a great market this year. I think we started the year around 70 billion or so of wealth management assets. We should be close to 80, depending when this recording comes out. So
okay, that's fantastic, David. So let me ask you this: when given that you've pivoted towards M&As, going back to maybe 2012, I think is what you said in that realm, specific in wealth management. Who would you see as like an ideal acquisition profile? Who is your ideal avatar in terms of partner?
Yeah, I mean, just like a lot of folks, Alan, it would depend. I mean, first and foremost, like everyone else, the cultural fit is paramount, and we define cultural fit in a lot of our conversations of kind of the questions that they're asking us. If it's about the grid or their compensation or what we're going to pay for the business, those are cultural red flags. It's usually about what, how is this going to benefit our people, our clients, and they can put those in whichever order they prefer, and lastly, the stakeholders. So cultural fit's huge. If it's a new market for us geographically, we like to see, around $1 billion or so to kind of launch a new beachhead for the firm. If you've got an existing brick and mortar in the area, it's a lot easier to talk to a $1 million revenue team or kind of a breakaway advisor if there's the infrastructure around to find it. But really, cultural fit, the geography matters a little bit, but we're really looking for clients that look like our clients. And that could be individuals and families. It could be retirement plans. Just from a service model and a infrastructure reinvestment standpoint, we really have a core target of anywhere from $3 to $10 million average client on the wealth side. We obviously have clients much smaller and much larger. But I would say that's something we kind of staff against things and invest in technology and systems around that core market. The retirement plan side, kind of the $50 to $250 million plan, you can do those all day.
Right.
So if the clients are a fit, the business model's a fit, the culture obviously needs to be first and foremost. We look at the location. We'll look at who they're using for technology and custodial relationships, what kind of investment philosophy they employ. All of that goes into a laundry list of things that we try to flesh out either through direct conversations, through folks like yourself in the middle, or from SIMs and websites and things like that.
Okay. Well, so let's now. Well, thank you. That's awesome. You guys have been crushing it and super impressive in every way. So congratulations on all the success. I want to now pivoting towards the succession question that we have here. Let's start with the current owners. Let's say I'm an owner of an RIA. I meet your profile criteria. You're a match for me in the ways that we're evaluating that. How important is it for you as the purchaser of my business that I actually become an owner? I roll a portion of my valuation into the equity of CapTrust.
That's a great question, Alan. I would preface it by saying we're a firm of principles, not rules. But if there were any rules at CapTrust, one of the ones that would be flirting with that term would be what you just asked. I mean, we want unless there's some other kind of extenuating circumstance, we want all the firms and the principals that join us to roll some of their equity into CapTrust equity. I think, what makes our culture so strong and so great, and some may say cult-like, is the fact that we've got, out of the 1,600 plus employees at the firm, over 950 of them are equity owners.
Wow.
A lot of that's through.
That's amazing. Yeah.
We'll talk about it later, a program in place for folks that don't come through the M&A door or didn't have equity beforehand. But, when we talk to groups, and I think I've heard you talk about it on your podcast before, of that, owners love their team. They've got the best people. They really care about their G2. And you look at their cap table and it's 100% ownership to one person.
Right.
And it's not, there's nothing wrong with that. It's hard to share equity. It's hard to distribute equity. But it is a question we want to dig into as to why. So it's vital for us. Required is a strong word, but it's almost required that.
Well, it's like it's evidential of how they think. Like for alignment purposes,
that's right.
You want people to own equity, like that incentivizes. It puts all this incentives properly, and so. I think that 950, did you say, of the 1,600? Yeah. I think that's a phenomenal statistic.
I mean, these are loose. It's not advisor math, but it is loose numbers. I mean, I think the actual numbers were like 964 as of, maybe last quarter.
Well, that really speaks to what you're saying. And I applaud that. I think it's fantastic.
Well, it's not easy to do. And it's a credit not to me, or, I mean, it's certainly the firm, but our founder, Fieldy Miller, had a vision at the beginning of if he could be a much smaller piece of a larger pie, we would grow faster as an organization. And we're in Raleigh, so we're in the Southeast. Chick-fil-A is a big deal. Yeah. And when you've got a model like that we try to emulate, you've got, each store owner has to work in the store. And so they're not worried about their culture permeating throughout all of the Chick-fil-A's across the country. We feel the same way. We don't have to worry about our culture, permeating outside of Raleigh if we've got owners in all of our locations around the firm. And that's paramount to how we find and attract talent too. I mean, a lot of firms have not figured out the equity thing, and we feel like we've got a unique advantage in that space.
So this is a great segue. So let's say we have that situation where the equity is owned by one owner, maybe two or three, and they're the founders. Okay, they're the senior owners, the senior client-facing advisors. Mm-hmm. But there's Gen 2 on the team, but they haven't formalized, a transfer of equity. Maybe they've had some casual conversations about it with their younger folks, or some have made promises, nothing formal, but they've had these conversations. When a firm currently doesn't have ownership across the team, how do you address that in the acquisition itself, or do you attempt to address that? I mean, do you go in and say, look, these are people that we think should own equity? Probably the owner is having that conversation, but how do you address that in the actual acquisition? And then I want to get to what is the post-acquisition opportunities that exist?
Yeah, that's how I would set up the conversation too. If you were a prospect and we were talking, hopefully, and back to our earlier point, culturally, if you're the owner of that firm, you're asking us how to help you solve that.
And I find that to be the case. That's more the norm. The owner is like,
if that's another red flag. It's not a deal killer, but it's certainly something we want to dig into. But if they're asking us that question, we know their heart's in the right place. It's hard. I mean, I'm G2 or 3, depending how you think about it. I mean, I don't want to go to the bank and have my wife co-sign a loan to go buy a fraction of a percent of a business that who knows the viability of it. So the way we do it is they usually have kind of a preset list in their mind of whether it's a G2 advisor or a G2 employee that's been vital to their success and growth that they want to make sure they take care of in a transaction. There's two different ways to look at it. One is through incentive. You want to make sure they stay on, that they grow, that they're going to feel like they've got skin in the game. And there's also a reward aspect of, hey, they've helped me get here. We've just never been able to figure out the equity thing. And so we'll work with the team. We don't like to equitize the entire team on the way over if they're not already, because we want to make sure that it's still aspirational.
Yeah.
And it still makes those people that do get it feel more special at that time, knowing that the others will soon follow a few years later. So we'll work with them on it. It's typically a little bit of give and take. And if it's, 100% owner, we'll ask them to carve out a portion of their proceeds to equitize their team. And they could even do that in the form of vested equity or non, depending on the role and the title and kind of what they see this person doing or what they've done historically.
Yeah, it's I'm glad you said that, because it's really no different than if they were to do it themselves pre-transaction. So the entity has value, and if they were going to award or sell equity to a team member, whether it's a client-facing advisor or an operational staff member, it's really no different in the transaction. There's a valuation being placed on the business. Now it's liquid. Often they have the opportunity to take some of that consideration in cash versus equity. It's generally no different. You're just going to allocate a portion of that now to your team members.
That's right. And I'm not a CPA, or I'd pretend to be, after staying at a Holiday Inn. I think there's some tax advantages to them. One, taking more equity in the transaction than cash themselves as the seller. There's also a tax advantage to taking some of your cash proceeds and gifting, in the form of, or granting in the form of equity to the team as well. So and for us as the buyer, it's a great cultural green flag.
You like to see that. You like to see them taking a part of the valuation proceeds.
And it's a fun conversation for them to have. Not us, when they tell their team they're, one, selling, and two, they want to make sure that that their team comes along with them. We say, hey, look, we'll help you figure out the numbers and who gets what ahead of time, and then you go have those one-on-one discussions, Mr. or Mrs. Seller, with your team, and say, hey, I really value your contributions that got us this far. I want to make sure you feel invested and aligned. Or it's like, really excited about your future here. I want to make sure that this is a good move for all of us. And I feel like it makes them look like the hero in a sense when they get to go back and have that discussion. Even though
absolutely, it's often it's an accelerant to the equity transfer. I think, because often these owners who are having these casual conversations with their team, they just never get around to doing it. And so now in this transaction, it's actually a catalyst to actually handle or facilitate that equity transfer. So it's good for the employees.
And there's so much change management going on during the transaction that the equity part can really help smooth over some of those conversations, or kind of mitigate the feelings of emotions or the implied risk that people may have. So it helps all around.
So in summary, on the initial acquisition, one, you love it when the owner wants to allocate equity in the deal to other contributing team members. Not everyone per se, but the ones who are definitely critical to the success long term and are driving the growth of the firm. And they would just really look at the valuation proceeds and allocate a portion of the proceeds, whether cash or equity, to those team members based on those conversations that they would have with you. So that's awesome. Okay, now we've done the transaction. We're on the CapTrust team, and we have some high achievers. Maybe we've recruited some advisors, for example, to our team that weren't a part of the initial transaction. Is there a pathway to equity for post deal?
Yeah, it's a great question. I mean, the only reason we don't have more than roughly again, advisor math, roughly 2/3 of our employee base as shareholders is that they haven't been here long enough. So there's two paths to equity, whether you come through the M&A door or you were hired organically off the street. Advisors have one path, and it's typically growth. You've got to hit a certain growth number for a sustained couple of years. You've got to be a good corporate citizen. You've got to be active in your community. There's a few things that are quantitative, and there's a few things that are qualitative.
Right.
For advisors to become, we call advisors that get equity post-deal partners.
Yep.
Just partnership mentality. I don't really know if we've defined partnership different than a shareholder, other than just advisors get it. And then for the non-advisors, client service, operations, anyone that's not out servicing clients or finding new ones every day, once they come through, whether it's M&A or off the street hire, once they're at CapTrust for 3 years, they automatically receive a grant of equity as part of compensation after their third year. Okay. Honestly, whether they want it or not.
It's interesting dynamic, because a lot of employees, when given the choice, they'll take the cash. And they should take the equity.
It comes up, especially as you can imagine with the younger folks, and we try to tell them, look, as we're financial advisors, as an industry, this is good for you. It's tax advantaged. You've got your 401k, you've got your compensation, you get your discretionary bonuses. The equity is something that you've got to be present to win. So we don't want the passer throughs or the flybys that take their equity, stay for a couple of years, then leave. And you've got to be present to win. You've got to, retire here, or, you leave for a reason to take it with you. But we want everyone in theory walking the halls as shareholders for all the reasons that you mentioned at the beginning of this call, and probably in the forward to this podcast. But there's alignment across the firm. We have one P&L for the whole firm, not by office. We think it's a distraction to run a P&L locally and compete for who's more profitable. We've got advisors hopping on planes every day to go help another advisor or another office win a piece of business and asking for nothing in return because they're all shareholders. At the end of the day, if we just want to win that client or win that opportunity, and we don't want to be worrying about grids or kickbacks or rev shares or, some of that stuff can happen organically. But again, we want to keep the management out of it, keep a very flat organizational structure and let advisors go do what they do and not be distracted by, again, at the beginning of the call, like all the business owner decisions and rules and regulations that can slow folks down. And really, it's not productive or helpful culturally either.
Yeah, someone told me today they called it administrivia. Not being distracted by all the administrivia. I thought that was a great.
Yeah, I mean, we want our teams. We call it all of our offices teams. They're not branches. They're not necessarily locations. We want all of our teams to do two things. We want them to basically grow and lift others. That's it. Yep. And they grow by keeping their current clients happy and finding new ones. Everything else, other than those things, could be done more efficiently. And you know this, probably cheaper and quicker and better, honestly, by someone other than themselves. So.
They're not contributing any value based on their ability to run AP
and advisors are compensated, broadly in a variable structure. So they go out and we win a new piece of business. They get a raise, almost instantaneously. They come back, throw a bunch of papers on their team's desk, and they go play golf. The team's now got more work, but their shareholders, one, and two, we have basically a performance bonus for the firm if we hit our growth targets throughout the course of the year for everyone that's not an advisor. So that way the firm feels like they've got skin in the game from a compensation standpoint if we keep winning and growing organically. So all those things are meant to kind of encourage alignment. Fair's not equal, but it is consistent across the whole firm.
Well, when you're aligned properly, you'll perform. I mean, that the performance is, it's like self-remedying, self-healing when you have equity in the hands of the people that are driving the bus.
And I just quickly add too, and it's not unique to CapTrust, but a lot of the firms that are better than most at sharing equity with their team, I think we're in that crew. Sometimes we get questions from potential sellers. They're like, well, what if we don't want equity? Or what's the liquidity? They get really hung up on the terms of the liquidity. And we say, look, this is something that's supposed to reward long-term tenure, growth, loyalty, culture, all of those things. And by the way, here's the performance history, which we can't guarantee future results, but this is a pretty good asset to have. And I think any national firm that's got good organic and inorganic growth channels and methods are going to have pretty strong performance over time, which is going to far outpace any individual team that's out there.
Oh, absolutely. Well, I've seen those numbers that you're referencing, and they're incredibly impressive. So I'm very bullish on CapTrust.
We keep challenging the firms to join us. Like we have not had one group in 20 plus years join us that's outpaced our equity over time. They may have one good year, but then inevitably something happens and, flat year, a client leaves or whatever, but no one team has outgrown our equity, which we think is a good thing with what we're reinvesting in the firm and the diversified advisor experts that we have out there in different pools and niches and, revenue generation. So it's been a good story for us.
Well, awesome. Well, David, I really appreciate all of the information on CapTrust. You have a wonderful story in how you guys handle the equity distribution amongst Gen 2 advisors at the initial transaction and post acquisition. It's clearly a partnership model, and I think that's awesome, and definitely one of the reasons you guys have been so successful. So, thank you for coming to the Buyers Boardroom.
No, thanks for having me, Alan. This was great.
Absolutely, we'll be in touch.
Great, thank you.
Well, that was a great interview with David. I always love having him on, and I love seeing how focused they are with their deal structure and really equitizing everyone.
Yeah, no, fantastic interview. He's great. They're great. Look forward to many successful partnerships with them.
Totally. Well, I've got a mailbag if we've got the time for it. What do you think?
Yeah, lay it on me. Let's go.
Okay. So it says here, Dear Alan and Jacqueline, love the show. My partner and I were both 50 years old, run a nice practice. We know an acquisition at some point will be on the horizon, but we aren't sure if now is the right timing. What's the best way to evaluate if the timing is right now?
Oh, yeah. Well, that's a great question. Actually, probably one of the most common questions we get. It's sort of rooted, in the same category as firms who are struggling with giving up independence. This I find is really common amongst firms who are growing fast. Now, I don't know if
Yep.
this particular
True.
person is growing or not, but usually it goes like this. It's like, we're growing at X% a year, and we know what our valuation looks like today. If we just wait 2 to 3 years and enjoy this growth rate, our valuation is going to be, like 50% more, or whatever the metric is. So just basically saying that we're growing so fast, we don't want to forego the valuation that we're anticipating if we hit those growth rates. Okay. So
Right.
my kind of standard answer to this is that problem never goes away. Right?
Right.
It's like, if you're at 50 today and you're saying, why don't we wait 2 to 3 years? Well, when you're 52, 53, assuming you did grow what you anticipated to grow by, you're going to be asking yourself the exact same question. Why don't we just wait 2 to 3 years more and enjoy that growth? And so it's this perpetual, never-ending issue that you're going to be forced to deal with at some point. And the problem, well, it's a math question, essentially, but part of the challenge is quantifying the delta, the difference between the two. Because in the one scenario where you're staying independent, it's a full 100% risk on position. Like, you have all of the risk. Now it's the risk, kind of similar to what we were talking about in the show today. So it's the one you're familiar with. But there are some embedded assumptions in that risk that the markets are going to behave.
Right.
Something isn't going to happen from an external source that affects our business or the viability of your practice, health, your team, like all these things that are real risks in your current setup, you're assuming aren't existent. And the reality is
Right.
they are. Okay. So you're comparing that against transacting. And in the transaction, you're going to de-risk your asset to a degree. Right. And so you're comparing a 100% risk on position to a de-risking of your asset via the acquisition. And when you do
Mhm.
that, so let's say you sold your business and you took 80% in cash, 20% in equity. So you went from 100% risk on position to a 20% risk position. Just by default, that 100% risk on scenario should mathematically outperform when you de-risk
Right.
the other asset. It's hard to really compare. However, there's a lot of things that need to go into the equation on the side of the transaction today. If you're rolling equity, how does that equity perform against your current ownership? So like
Right.
we've seen transactions, Jacqueline, where the seller rolled 20, 30% into the equity of the buyer, and that 20 to 30% was worth as much as the cash 3 to 5
That's
years later.
exactly right.
So how do you know that equity that you would have taken wouldn't have outperformed the current ownership equity that you have today? How do
Yeah.
you know that the ability to grow with your new partner isn't going to be materially better? If they're removing all of the operational burden, they're surrounding you with resources and expertise, they're bringing in organic growth capabilities, all of that should equate to a faster net new asset flow than what you have today. So
Right.
how do you quantify that? It's virtually impossible. And then we're forgetting all of the quality of life benefits that come as a part of a larger organization. Getting back to that, getting out of operations to focus on clients or mentoring other advisors who do that. All of the expansion of services and capabilities that make us better as a team, more attractive to clients. Again, the organic
Mhm.
growth initiatives that a partner might bring. That's not even factored into this equation because it's just simply a math thing. So all that
Yeah.
to say is, when is the right time? I think from an age perspective, before 55, I think once you cross 55, that raises the question of glide path, to the
Mhm.
buyer. How long are you going to be around, and what does that look like in potential impairments to the business?
Right. How much excitement will you have around growing the business
Exactly.
after the close?
Because as
Yeah.
we've talked about on multiple shows, like, we're buyers from a purely mathematical perspective, where they make their return is in post-acquisition growth of the
Right.
businesses that they've acquired. And once you get up to 60, 62, 65, let's be honest, you could tell them to your blue in the face that you want to grow, but they're asking ourselves, is there gas in the tank? Are you
Yeah.
really
They know you want to
serious?
go buy a boat. Yeah.
Exactly. So,
Yeah.
to this, there's a lot that goes into making the decision of when the right time is, but that problem will never go away. And so we just have to really explore what are the benefits to transacting now. What would you be foregoing if you waited 2 to 3, 4 years, whatever, to transact? Would your business be materially impaired because you're older? Clients are older, everything's
Your
older.
clients are
Yeah,
older.
it's like
Yeah.
it's a really loaded question, but so hopefully that helps. There's a lot that goes into it, but certainly from an age perspective, not that if you waited till you're 58 or 60, it's not like your business isn't going to be attractive. It's just red flags start to go up. Questions are
Right.
starting to get asked. Answers need to be had around all of these topics. And people who are younger than 55 typically don't even get those questions because they're assumed that they're going to be around for a period of time. So anyway, great question though.
Yeah, I like it. Well, and I like the introspective lens of your answer too, where it's like, what do you want your next 5 years before you retire to look like? 5, 7 years, whatever the timeline is. What do you want that to look like? Do you want it to look like in your projection, managing more people to be able to get to that level because you don't have centralized resources to lean on to be able to scale? Do you want to scale back the back office things that you oversee today and get back to working with clients, building new business, having more time to focus on that? Like what do you really want your life to look like?
Yeah, we call it the ideal outcome, and it's trying to capture you have a reality that you're dealing with of your current business. But then there's this partnership reality. Like, what do you want that to look like? And that's in your partnership preferences. What, to your point, like, what are you seeking in business lift, quality of life improvements, expansion of services and capabilities, operational burden reduction, assistance with growing, all of these things. And what degree do you want to control those things? What degree do you want to manage them? Do you want to, like, we have some sellers that come to us and we just want to get out of every aspect of the business except for working with clients. And we have some sellers who say we want to partner with someone who can help us, double and triple our size. And we want to be involved in that build out and just aggressively go get it. And this point you in different directions, but you have to know the answers to those questions to really make the decision of timing. So,
Awesome.
All right.
Well, great episode.
Well, enjoy your sunny weather. I'll enjoy my cold snow.
Sounds good. All right. Bye,
All right.
Alan.
Thanks, Jacqueline.
Thanks for listening, everyone.
Bye.